Hello and welcome to Owner's Equity Stock Dividends. My disclaimer and copyright notice: the information and opinions in this presentation are those of the author only and not the author's employers or affiliated organizations, including but not limited to Irvine Valley College and the South Orange County Community College District. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2020 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. So today we're going to be talking about stock dividends. And stock dividends, similar to cash dividends, are not mandatory. However, when stock dividends are declared, the dividend must be distributed. We have three different dates. We have the date of declaration, the date of record, and then the date of distribution. Stock dividends work differently than cash dividends, mainly because we're not giving cash, rather we are giving out additional shares of stock. And this is really kind of where this is, I don't want to call it controversial, but when a stock dividend occurs, the shareholder is really not necessarily going to be better off than they were before. They now hold more shares because they're getting additional shares. That's really what a stock dividend is. But as a result, there are now more shares outstanding. So the way this does still happen, though, by companies, it happens from time to time. I've witnessed it a few times in my career. So we'll talk about a little bit about it today. So here we go. So the key thing with stock dividends is how we record it. If a share dividend is 25% or less of the outstanding shares of the company, it is determined to be what we call a small stock dividend. So 25% or less. If it's 25% or less, we're going to be recording the stock dividend at the fair value of the shares. So if I am, Apple, actually I don't even know what the stock price is of Apple today, but if I'm Apple and my market price per share is $150, then I'm going to be recording that stock dividend at $150 per share, as long as the amount of the stock dividend is less than 25% of the outstanding shares of the company. So let's take a look at this example right over here for Recharged LA. So we have Recharged LA has 2 million common shares authorized and 400,000 common shares issued and outstanding. The common shares have a par value of 0.0001 per share, and they declare a 20% stock dividend on January 15th, 2018. The dividend is distributed on January 31st. The fair value of the shares is estimated to be at $25 per share on the date of the declaration. So right over here, we've got, again, the two dates we're always going to be concerned with are the date of declaration and the date of distribution. So the first thing we have to ask ourselves is this a small stock dividend? So if the stock dividend is less than basically 25%, we record stock dividend at the fair value. Okay. So right over here, since it is 20%, we're going to be going through and recording this at the fair value. So the way we're going to determine the amount of the stock dividends, we first need to figure out, well, how many shares are being distributed? Well, we have, the key is going to be on the outstanding shares. So the company has 400,000 shares outstanding. Remember, the key difference here between authorized is the total amount that I am allowed to issue, and then issued and outstanding is how many are actually have already been distributed to date. If you look at a company's financial statements, and I'll just pause this real quick and show you one. So we're here at Home Depot's financial statements, and we see over here we've got common stock, par value, 5 cents per share, authorized are 10 million shares, or I should say actually these are in, these amounts are in millions except for per share data. So this is actually 10 billion shares. Issued are only 1.7 billion shares, and here outstanding they had 1 billion 90 million shares as of November 3rd, and then over here as of February 3rd. So the important thing to remember right here for a company like Home Depot is that authorized just tells you this is the total amount that they actually are allowed to give out. That doesn't mean that that is reflective of how many shares are in fact actually outstanding. And we'll see in a later video why there's a difference between issued and outstanding, and what it really has to do with is this part right down here, which is what we call treasury stock. So this Home Depot has actually bought back a significant amount of their shares over time, but that's why there's a difference between issued and outstanding. But outstanding refers to how much of the shares that have been issued are actually being held by outside individuals outside of the corporation. Well, let's go back over here and take a look at our more simplified example. So the first thing we need to figure out and do, so they've got 2 million shares authorized, don't really care about that number. They do have 400,000 common shares issued and outstanding. We do care about that. So if they're declaring a 20% stock dividend, I need to take the amount of outstanding shares. I'm going to multiply that by 20%. What this is going to be giving me is going to tell me is the number of shares that are going to be issued as part of the stock dividend. So this is going to be 400,000 times 20%, or right over here, 80,000 shares. So this tells me right here is that 80,000, these will be the shares issued as part of the stock dividend. So we've got 80,000 shares being issued as part of the stock dividend. The next thing we need to go through here and do is to say to ourselves, well, that's the number of shares are being issued. Is this a small or large stock dividend? If it is a large stock dividend, meaning it's greater than 25%, I'm going to record the issuance at par or par value. However, since the stock dividend is less than 25%, I'm going to be recording it at the fair value of the company's stock. So on the date of declaration, it tells me that the shares value are estimated to be $25 per share. So here, it's basically we record at fair value. So the dollar amount or the value of the stock dividend is going to be 80,000, which are going to be the number of shares, at the fair value, or $25 per share. So the total amount, of the stock dividend is going to be 80,000 times $25 per share, or $2 million. So that is going to be the total amount in terms of the dollar value of the stock dividend. So now that we know that this here is $2 million, how do we go through and actually record the journal entries? So the ones we're going to be concerned about here are going to be the date of declaration, and then it's going to be the date of distribution. So we've got the date here, which is 1/15/2018. For my accounts here, right, I have an option. Okay. So when I record the dividend, I can either record a stock dividend, or I can also debit retained earnings. Remember from our discussions previously, what happens to dividends? Well, they ultimately get closed out to retained earnings. So I can go ahead here and I can debit stock dividend, or I can also debit retained earnings. It's really a matter in terms of the preference. It might be initially coded as a stock dividend. and then it gets closed out to retained earnings. So here, the amount that I'm going to be recording the dividend for is going to be $2 million, or the amount of the fair dollar amount times basically the number of shares that are being issued. So that's my debit. What are my credits going to be? Well, because on the date of the declaration, I have not actually given out the shares. What I'm going to do is I'm going to call this common stock dividend distributable. And what this is going to be the par value of the shares being issued. And to determine the amount of the par value of the shares being issued, and you can go back to the earlier examples of this, what I'm going to do is right over here, my shares being issued are 80,000. My par value per share, is right over here. It's 0.0001. So my total par value of the shares to be distributed it's going to be $8. Okay. So right over here, I'm going to go over here, common stock dividend distributable, because again, I have not yet distributed that yet. And this is going to be the par value of those particular shares. So right over here, that's what I do here. Now, from the rest of my journal entry, at least on the date of the declaration, I'm going to have over here, additional paid-in capital common stock. What is this going to be? This is going to be a balancing entry, or the $2 million minus the $8 per share. And this is how I go through to record stock, to record declaration stock dividend. Okay. So that's how I record the declaration. Now, in terms of when I actually give out the shares to the shareholders, what I'm going to be doing right over here is on 1/31/18. Here, I'm going to be debiting my common stock dividend distributable for $8. And then what I'm going to be doing is, because I'm actually giving out the shares, I'm going to be crediting common stock at par for $8, okay, to record distribution of stock dividend. So as we look at this right here, ultimately, this kind of looks like, well, I'm selling stock for cash, but I'm really not. I'm not receiving cash. I'm debiting retained earnings. So, but ultimately, this part here is that I'm recording this common stock dividend distributable, which is really like common stock at par. And then ultimately, I'm going to be closing this out to par once I actually go through and distribute the dividend. So this is how we go through and handle stock dividends. Again, the first thing you want to go through and do, is it a large dividend? Is it a small dividend? If it is a small stock dividend, we're going to be recording it at fair value. First thing I have to do is to figure out how many shares am I giving out. I take the shares outstanding, meaning what is being held by, not being held by the company, which has previously been issued, take the number of shares outstanding, multiply that by the amount of the stock dividend, which here is going to be 20%. This is going to be 80,000 shares that are going to be distributed. So once I know it's going to be 80,000 shares, I take those 80,000 shares, multiply it by the fair value per share, and this gives me the total amount that I'm going to be recording the stock dividend for. When I record it, I have the option of either using retained earnings or stock dividend. You'll find it both ways out there. And the second thing I'll need to do then, once I've done that part, is to then figure out what is that par value for those shares. To figure out the par value for the shares, I take the number of shares being issued and I multiply it by that par value per share, which is 0.0001. So this gives me $8 per share. Right over here, got that $8 per share. This is called, when we declare it, it is not, because we haven't given it to the shareholders yet, we're calling this a common stock dividend distributable. So what's the ending balance here? It's going to be, my ending goes to additional paid-in capital common stock. So this is how I record the declaration. Now, in terms of actually showing the distribution, I'm going to debit common stock dividend distributable, I credit common stock at par, and then I'm done. So this is kind of how stock dividends work. Again, want to thank you for joining me here on this great accounting journey. Thank you for watching. Please do not forget to like and subscribe. If you have any questions, feel free to email me at 1812cpa@gmail.com for future videos or whatever else may have you. Have a great one, and I'll see you tomorrow.